6 undervalued dividend stocks near their 52-week lows to buy now. We're going to take a look at the historical performance of each company. We're going to look into their dividend safety. We're going to run through some important financial metrics. And as always, we're going to run them through the valuation model, getting to our intrinsic value as well as our acceptable buy price, given that investor margin of safety, and we'll look towards Wall Street to see what they're forecasting over the next 12 months. Jumping into the first company, we have Starbucks Corporation. It's down 15% over the last year. We can see it's towards its 52-week lows with a yield of 2.45% and a forward P of 23. If you've been holding this over the last 10 years, you'd be up 157%. Bear in mind, it doesn't include those dividends reinvested, and we can see all-time highs July 2021 at $126. Let's take a look at the dividend safety, a score of 67. It is safe. Market cap just over 100 billion, a mega cap company. Quick recessionary metrics for those that see a recession inbound. Well, they didn't pay a dividend in the last recession. They had above average growth, -6% versus the S&P's -12, but they also significantly trailed the S&P, -69, with the S&P coming in at a -55% recession return. Dividend growth from Starbucks, fairly nice, 7.5% last September, double digits over the last 5 years, a strong 17% over the last 10 years. This is what we love to see as dividend growth investors, and they have been increasing those dividends for the last 13 years. In terms of dividend yield theory, it states the company is undervalued when the current yield sits above the 5-year average, 2.45 versus 2.01, so we have our first sign here of undervaluation. Do bear in mind we're not looking at any of these models in isolation, and we'll conclude towards the end. Forward P, also another undervaluation signal, 22 versus that 5-year average of 29. And when we look at the consumer discretionary sector P, it does sit much lower at 15. Now, regular viewers will know we focus our attention on the right on the free cash flow payout. The reason for this, the earnings data in general is susceptible to manipulation by management through accounting. So we look for free cash flow payout. My personal preference below 60%. If you want to be industry specific for restaurants, you can go down to 50%. 2022 was pretty high at 90%. The more recent year, 67%, looking a lot healthier. 2024 expected 63%. It is something I can be happy with. It is around that 60%. Moving on then to the free cash flow per share, we can see that over the last 10 years it has increased. In fact, 2014, -37 of free cash flow per share. 2023, 320. So it has gone in the right direction. Just bear in mind the inconsistencies year on year. 2024 as well, we are expected to see a small increase to $3.59. Sales growth, what we typically look for the more mature companies, steady moderate growth, 3 to 7%. With Starbucks, we're seeing nearly double-digit increases to the top line every single year. We have that notable pandemic year, -11%. It is justified given that the stores were shut down. Consumers were unable to get their coffees for a portion of 2020. In terms of the numbers then, numerically, we can see it has more than doubled, 16 billion in 2014. 36 billion in 2023. They've also done share buybacks, returning excess cash to investor pockets, reducing that share count from 1.53 billion in 2014 to 1.15. Now, we have just released in our latest article about share buybacks year on year, how important they are. We've run through companies essentially buying back a lot of shares, returning excess to investor pockets. If you want to grab a copy of any of our articles completely free, click on that pinned comment below and you can start reading straight away. So let's take a look at the ROIC. Again, this is covered as one of my 7 golden dividend metrics in my free newsletter. We're looking at 10% or more. This effectively shows us that management are able to effectively allocate their capital. Very strong, 33% in the more recent year. Other than that, though, consistently pretty much above that 10%, so we love to see that as investors. Margins then, operating margin for the restaurant industry, we want to see above 16% ideally. What we can see here is over the larger part, they have really struggled year on year. Notably, that pandemic level, it did drop down to 7%, but otherwise it is pretty much straddling around that 16%. Free cash flow margin, a little bit better. We want to see above 5%, and we have seen that over the last 3 years. Now, looking at the net debt to EBITDA, this is the earnings before interest, tax, depreciation, amortization. Now, this directly correlates to two things, the balance sheet strength as well as the dividend safety. We want to see below 3.5 for the restaurant industry, and these are the number of years it would take the company to pay off all of their debt net of cash on hand. 2.06 in 2023, looking very strong. 1.89 in 2024. Nice to note it has been decreasing, and that gives us faith that 1, the dividend is safe based on this information, and 2, the balance sheet does look secure. So let's jump into the valuation of Starbucks Corporation. And as always, if you enjoy the content, values being provided, smash that like button, hit that subscribe and bell button so you are continually notified of these videos as they drop. Now, typically on the channel, we do run through every single one of these models to get to the intrinsic value. For today's episode, let's jump straight into that final calculation, which is just the average of these three models, coming to $113. So as we can see, with the current price around $93, we start off with a margin of safety of 10%. Now, we use this if we believe it meets 3 criteria: a wide moat, strong financial metrics, and good forward-looking data. So we keep going until it's roughly near the current trading price, and we can see it isn't at a 20% level just yet. So based on our estimates and judgments for Starbucks Corporation, we see 15 to 20% margin of safety. In terms of Wall Street, over the next 12 months, they see a price target of $109 with upside of 17%, so they do believe it to be a strong buy now. As always, when we run through these companies, drop your thoughts and comments below as to whether or not you are adding any of these or just putting them on the watch list. The next company that we are taking a look at is Bristol Myers Squibb. Now, they're down 30% over the last year. Over the last 10 years, down 8%. And we can see their all-time highs not too long ago at $81 in November 2022. Again, pretty much trading at their 52-week low with a yield of just under 5% and a forward PE of 7.22. Dividend safety score 70. It does look to be safe. Market cap 100 billion. It is a large cap company. Now, in terms of those key recessionary metrics, well, they maintained the dividend during the last recession. They had below average growth at negative 21%, but they did outperform the S&P negative 32%. Dividend growth, very nice as well for a nice starting yield. You're getting an above inflationary increase, 5.3% last December, 7% on average over the last 5 years, and 4% on average over the last 20 years, at least keeping up with inflation, as we always advocate on the channel, a minimum of 4%. They have been increasing those dividends for the last 17 years and paying without a reduction for the last 53. In terms of dividend yield theory, as we can see, a massive sign of undervaluation, both on that yield, 4.83 versus 3.15. Likewise, on the forward PE being below that 5-year average. And we also note it is significantly lower than the healthcare sector PE of 17.4. So let's take a look at the free cash flow payout. I like the fact that over the last 8 years, it has been in fact below 60%. 23 at 38%, 2024 expected to go even lower, so I would like to see a nice high single-digit increase to the dividend in 2024. Free cash flow per share, what more can you want? It is increasing over the longer term, 158 to 611, expected to go even higher to 731. Yes, it isn't consistent every single year, but over the longer term, it has increased substantially 4 times and is expected to continue that growth in 2024. Sales growth, the one thing it is lacking is that top line increase over the last 2 years. In fact, the last more recent year of 2023, we see a negative 2% to that top line. Now, this is a very high level review of Bristol Myers. It is one we have covered in detail on the channel, so if you do want a very in-depth review, do go check that out. Numerically, we can see their top line has in fact nearly tripled from 16 billion in 2014 to 45 billion. Shares outstanding, unfortunately, they have diluted your position as a shareholder if you have owned this since 2014, 1.67 billion to 2.08. Now moving on to the ROIC. Personally, I'm not too disappointed with this. The last 3 years, it is around that 10% or more. However, one thing I would like to see is it back at the levels we saw previously, looking very strong and healthy in the low 20s. In terms of the margins for biotech, we do have some high expectations, around 25% or more. It has hit that once. Over the last few years, it's just straddling below that, around 18 to 21%. On the other hand, the free cash flow margin from 2017 has been increasing, 28% in 2023. Very nice to see, especially given how important the free cash flow is as a metric. Net debt to EBITDA then, 1.63 in 2023, a little bit higher than the 1.5 we look for biotechs, expected pretty much the same in 2024, so it's not the worst. The dividend does look to be safe, but one just to keep an eye on, especially given in 2019 how high that figure did go. So what about the valuation of Bristol Myers? Let's take a look, and don't forget, if you want, you can grab a copy of the valuation model to get to the intrinsic value as well as the acceptable buy price of companies in your own portfolio and on your watch list by clicking on that pinned comment below. So we keep going until we have a margin of safety which is around the current trading price, and we can see at a 30% margin of safety it is around $1 difference. So for Bristol Myers Squibb we see a 30% MOS. In terms of Wall Street and their forecast, well, they see a price target of $60 over the next 12 months with upside of 21%. Similar to Starbucks, Wall Street do see this as a very strong buy now. We then move on to stock number 3, which is Pfizer Incorporated, down 36% over the last year. It does look to be in a very long downtrend over the last 10 years, however down 7%, and we can see its all-time highs just under $60 at the back end of 2021. Again, trading pretty much at its 52-week low with a yield of 6.2%. Now, in terms of the dividend safety, 75, it is safe. Market cap, 155 billion, a mega cap company. Those recessionary metrics show that they cut the dividend during 07-09. They had above average growth, and they also outperformed the S&P with that negative 45% return. Dividend growth pretty poor, 2.4% in December, so it was below that inflation target. However, over the last 5 years and the last 20 years, on average, you are getting an inflationary / slightly higher inflationary increase, and they have been increasing those dividends for the last 13 years. In terms of dividend yield theory, we have that sign of severe undervaluation, 6.09 versus 3.92, although we do note the forward P is pretty much in line with the 5-year average. Sector P comparison, well, healthcare is still much higher at 17.4. In terms of the free cash flow payout, now this is one of the reasons why we do say continuously that this is our main focus. In 2023, it is expected, and in 2024, that they're paying out more in dividends than they're generating in free cash flow. This is our first red flag indicator, so something just to be aware of as a shareholder or potential shareholder. Free cash flow per share, $2.44 in 2014, $4.64 in 2022, but we do note in both 2023 and 2024 it is expected to go lower, so something to bear in mind, although we do know with Pfizer they are acquiring a lot of small companies to help with their growth process. Sales growth, then we see that post-pandemic drop negative 42%, although before that we did see some very large increases. But when you put the pandemic to one side, from 2014 to 2019, their growth on the top line was very, very poor, so do be aware of that. If you want to see similar to Bristol Myers, we have done an in-depth review of Pfizer, so do go check that video out. And we can see their top line has gone from 50 billion in 2014, peaked at 100 billion in 22, before coming down to 59 in 2023. They've also done some share buybacks. They have returned some excess cash to investor pockets, reducing that to 5.71 billion in the latest annual report. ROIC, very poor for 2023 at 3%. Other than that, some years it does very well, some years it does mediocre. 2022 and 2021, no surprises there, very strong. 2023, again, a little bit of a red flag indicator, just something to bear in mind. It doesn't necessarily mean it isn't a good company to invest in, but these are things you should consider, especially when you're looking at your investment thesis and your price valuation with your margin of safety. Operating margin, they have both struggled at 9% in 2023, as well as the free cash flow margin, which is expected to drop down to 12%. But again, other than that, before that, it has looked fairly healthy on both sides. So no real worries. You could argue they are expected to bounce back in 2024. But again, it is imperative to look at management's forward guidance to see what their expectations are to have those essential future projections. Net debt to EBITDA 1.75 in 2023, below that 3, and in better news, 2024 expected to come down to 1, so it does look like it is healthy in terms of the balance sheet as well as their dividend safety. In terms of Pfizer's price, then let's jump in. That is quite important. If it is a stock we do want to invest in, we always want to make sure we're buying it at the right price. So an intrinsic value of $35. Now the current price isn't too far off, around $27.54. At a 10% margin of safety, a buy up to $32. At 20%, we can see it isn't too far off, just under $1 shy. So for Pfizer at these current prices, we see a 20% MOS. with Wall Street expecting 15% upside, their price target of just under $32. Again, similar to the previous two companies, they do see this as a strong buy. So do let me know your thoughts so far. We've gone through 3 stocks, whether or not you agree that all 3 so far are a strong buy now. Stock number 4, it is Cisco Systems. Now they're down 5% over the last year. Over the last 10 years, however, they are up 119%, and we can see their all-time highs around that $65 level in the back end of 2021. The yield sits at 3.3% with a forward P of 13.2. Dividend safety, very safe, 91 score, market cap 199 billion. In terms of those recessionary metrics, well, they didn't pay a dividend, so no comparative data. They had average growth, but they did have a slightly worse off return at negative 59%. They in fact increased their dividend this month to 2.6%, not what I want to see, as always, a minimum 4%. Over the last 5 years, they got that inflationary increase. Over the last 10 years, in fact, double-digit increases. So a little bit disappointing that we do see that mediocre percent. They have also been increasing the dividends for the last 12 years. So let's take a look at dividend yield theory, another sign of undervaluation, both on the yield and the forward PE, although we note on both cases it isn't too far off, so you could also argue some slight reasonable valuation. We also see the information technology sector PE much higher at 26.7. Free cash flow payout, I love to see this consistency. It's been below 50% over the last 10 years. 2023 at 33% is a bit of a shame to see that. In fact, it's nice to see how low it is. It's a shame to see that they only increased that dividend by 2.4%. And in 2024, it is expected to increase slightly to 43%. Free cash flow per share, well, it has more than doubled over the last 10 years, although we do note an important thing here that 2024, they're expecting that free cash flow per share to drop down to 371. Sales growth, a little bit, in my opinion, inconsistent. We see some years of no growth, some years negative growth. In fact, the more recent year of double-digit growth is very nice to see, and hopefully by looking at management's forward guidance, we can understand whether or not they expect that trend to continue. Top sales then, 47 billion in 2014, 57 in 2023. Not the largest growth over the last 10 years, so do bear that in mind. And we can see their shares outstanding have essentially been bought back quite aggressively. In fact, more than 1 billion over the last 10 years, from 5.28 billion to 4.09. Taking a look at the ROIC, I love to see this. Not only is it consistently above the 10% I personally like to see, but it has been increasing, especially over the last few years. 29%, very healthy for 2023. Margins, very nice to know on both the operating and free cash flow side. In fact, the operating has been increasing. We can see some operational efficiencies. And 2023's 33%, very strong, the highest year. Again, lots of positives to note from Cisco Systems. Net debt to EBITDA, I mean, probably the best metric you can see on this channel when it is 0. Effectively, this means it wouldn't even take them 1 day to pay off all of their debt net of cash on hand. We love to see that here on Dividend Talks. So in terms of the intrinsic value, then it comes to an average of the 3 at $59. Now the current price, $49. Let's start off with our 10% margin of safety. A buy up to $53. At 15%, a buy up to $50.50. And at 20%, it isn't too far off, so we'd say between a 15 to 20% margin of safety for Cisco. In terms of Wall Street, not as high upside as the previous 3, but they still do see it as a buy with a price target of $54 and upside of 11% over the next 12 months. We then move on to the next stock, which is UGI Corporation. Now, this one does offer probably the highest yield we've seen so far today, 6.2%, a forward PE of just under 9, again trailing towards the 52-week low. However, we do know over the last year it is down 37%, and over the last 10 years down 17%, and it's been a while since it's hit its all-time highs of $59, again back end of 2018, so we're talking about nearly 6 years ago. Dividend safety score 60, borderline safe, market cap 5 billion. This is a mid-cap company. Now, in the last recession, they in fact increased the dividend. They had average growth, and they also significantly outperformed the S&P, negative 16%, when the majority of companies, as we've seen on this channel, have performed very poorly. Dividend growth, pretty nice, 4.2% last May, especially given the fact that you are getting a nice starting yield, so at least it's increasing in line with inflation. The last 5 years and last 20 years looking very solid as well. They are also a dividend aristocrat. Not only have they increased the dividends for the last 25 years or more, but they have been paying a dividend for the last 139 years without a reduction. Things you absolutely love to see. We have two signs of severe undervaluation, again on the yield as well as the forward PE. And when we compare it to the utilities sector PE, UGI is much, much lower. So let's get to the payout ratio. Now, when we look at the free cash flow, given it is a utilities company, it is a lot more volatile. So we draw your attention to the earnings payout. We want to see below 75%. That is nice to note that it's continuously, in fact, been below 60%. 2023 at 52%. 2024 expected pretty much the same. Nothing really negative to note there. Earnings per share, it has been increasing from $2 to $2.84. Again, not very consistent, but what I always say is very key. Always understand the type of companies you're investing in, whether it's a technological company, a cyclical company, a tobacco company. You have to set realistic expectations. Positive to note, 2024 EPS is expected to be driven higher. So when we look at the sales growth, this shouldn't come as any surprise given the cyclicality of the utility industry. We have years of double-digit positive growth followed by years of double-digit negative growth. 2023, negative 12%. And what I always say, always try and buy companies when they are out of favor, when they're out of the cycle. Total sales then 8.3 billion to 8.9, and we can see unfortunately they have diluted your position over the last 10 years with the increasing shares outstanding. But again, bear in mind that utilities do often rely on issuing equity. The reason for this is so that they can fund a portion of their growth expenditures. ROIC then, we can see it has been pretty much above 10% for the majority of the last 10 years, and in fact for utilities we do bring this down to around 7.5%. Being negative 5% in 2023, it is something we should keep our eye on. We don't want to see this negative for more than 1 year, but we can see from the trailing 12 months, it is expected to rebound up quite nicely. Operating margin then, we want to see around 18% or more for the utilities industry. Again, it has struggled. 2023, we do see that loss on the bottom line, hence the negative margin. But again, the trailing 12 months shows us that it is expected to rebound. As always, if you want us to do a deep dive in UGI, do let us know. It has been a while since we have taken a look. So for utilities, we want to see 5.5 or lower. 4.17 in 2023, expected 4 in 2024. It's not the worst. There is still quite some gap away from our maximum. So far, based on the information, the balance sheet and the dividend does look to be secure. So let's jump into the valuation of UGI Corporation, and don't forget you can grab a copy of this model if you want to get to the intrinsic value as well as the acceptable buy price of companies in your own portfolio and on your watch list by clicking on that pinned comment below. So we keep going to see what the margin of safety is. At 25%, it is pretty much 20 cents shy from the current value. So we see a 25% margin of safety for UGI Corporation. Now, Wall Street again see some nice upside. They do believe this is a buy with upside of 16% and a forecast over the next 12 months of $28.25. We then move on to stock number 6, which is the Hershey Company. Now, this has been driven down by the prices of cocoa rising year on year. It is down 19% over the last year. However, over the last 10 years, it is up 77.5%. Again, important to remember, it doesn't include those dividends reinvested. And we see the all-time high May last year of $275. It has a yield just under 3% with a forward PE just under 20. And we have a very safe dividend safety score of 93, market cap 39 billion. It is a large cap company. Now, in terms of the key metrics, while they maintained the dividend in the last recession, they didn't increase it, they didn't cut it. They had above average growth, pretty much flat in 07-09, and they also outperformed the S&P with that negative 30% return. Dividend growth, absolutely phenomenal. They increased the dividend 15% just this week. They had a 10% increase year on year over the last 5 years. And over the last 20 years, 10% year on year, looking very strong for dividend growth investors. Not only have they increased the dividends for the last 14 years, they've paid dividends for the last 94 years without a reduction. Dividend yield theory then, no surprise, is severely undervalued, probably the highest yield it has offered over the last 5 years, and we can see the same on the forward PE, 19.9, well below the 5-year average of 24.3, and we note it isn't too far off that consumer staples sector PE of 19.1. So Let's take a look at the free cash flow payout. 44% in 2022, 54% in 2023, expected to go slightly higher in 2024 at that 60%. Probably something I would keep an eye on. While 60% is acceptable, it has been increasing over the last few years, so just need to ensure it doesn't continue to increase the wrong way. Free cash flow per share, well, beautiful to see, more than 4 times growth over the last 10 years. 2023, though, it is expected to drop to $7.93, although we do see management are forecasting over $9 in 2024, so that growth train is expected to continue with Hershey. Sales growth, remember, steady moderate growth. We want to see 3 to 7%. Now, some years they haven't been able to attain that, but we can see the last 3 years looking very strong and very healthy. So numerically, we see the top line going from around 7.4 billion to 11.2. Now, they do share buybacks. They do return that excess cash to your pockets, but not as quickly as maybe you would like. They have reduced it from 225 to 206 over the period. ROIC, I love this, consistent and very, very strong numbers in the mid-20s over the last 6 to 7 years. The more recent year, 29%, gives me a lot of faith when analysing management in my thesis. Operating margin, it has also been increasing and it is above the minimums. Very positive to see on both the operating and that free cash flow margin. So always lots to love when we see margins that are very strong and continue to increase. It does show that efficiency within the business improving. Net debt to EBITDA, not only has it been decreasing from 2021, 1.452 is very, very strong. It's well below the 4 for consumer staples. 2024 expected not too far off. So no worries, we understand why that dividend remains to be very safe, and their balance sheet does look at a very high level to be safe. Now, intrinsic value then, let's jump into it for Hershey. And as always, if you do enjoy the content, value is being provided, smash that like button, hit that subscribe and bell button so you are continually notified of these videos as they drop. So margin of safety of 10%, we see a buy up to $206, at 15% up to $195, and it's not quite there yet at a 20% margin of safety, so we do see at least a 15%, somewhere between 15 to 20% at the current value for Hershey stock. In terms of Wall Street and what they forecast, well, they see this as a very strong buy now, upside of 18%, similar to the first few companies we analysed, with a forecasted price of $225 over the next 12 months. As always, though, let me know your thoughts in the comments below. Are any of these stocks of interest to you? Have you been buying over the last few weeks? Or maybe you've added them onto your watch list with certain price targets. As always, if you've enjoyed this type of content, let me know below. Smash that like button. Join us in the community by clicking on that subscribe and bell button so you are notified when these videos drop. And as always, have a great long weekend. See you on the next episode. And for now, take care.